Welcome back to ERM Advantage. Yes, I know it's been a minute. Sometimes life just gets in the way of our grand plans, but I'm very excited to be continuing on this series about effective metrics. Now, in the last video, we talked about the basic purpose and types of metrics, but since it's been a minute, let's just go back and recap some of the basic points we covered in the last video. In part one, we talked about the common issues and challenges that I see with how people use metrics, why metrics are one of the most important risk management tools that we have, establishing what metrics are and aren't, what makes a metric forward-looking or in some way predictive of a possible future event, the difference between risk monitoring and risk assessments, the different metric types, notably the difference between KPIs, KRIs, and KCIs, and the difference between business unit roll-up, and macro metrics. And then finally, understanding metric frequency. So if you missed that video, you can get to that here. In this video, we're now going to go deeper and be talking about identifying the best metrics from throughout our organization. From that, we'll consider some aspects to think about and how to identify strong metrics. And then we'll continue on from there to talk about documenting metrics and ultimately landing on how we actually present them in a way that is meaningful and actionable. So let's get into it. Now, before we get much farther, I want to take a look at a specific example and talk briefly about metrics in the sequencing of program development. If you're a smaller organization or really just starting to really build out a more formalized risk management program, I sometimes hear, well, we're just going to start by building a metric dashboard and then we'll start working on the other program components like risk appetite or risk assessments. The idea being that, well, at least we'll have something to produce while we build out the larger components. In general, this is not a good idea, and I'll explain why. Simply put, if you haven't defined your key risks, how will you know if you are tracking the right metrics? The value of metrics is defined by the degree to which they correlate to key risks. So if you're just reporting on something because, well, you feel like you should, not only is its value questionable, but you really have no basis of establishing tolerance thresholds, the yellow, orange, red, where management action should be taking place. You're just guessing, and that's not sound risk management. And this may be hard to hear, but if the board and senior management feel like you're just implementing random program elements that you can't objectively justify, in other words, process for the sake of process, they will likely lose confidence in your program, and that can really hurt you in the long run. Now look, in every industry, there are always some core fundamental metrics that everyone agrees are meaningful and everyone should be tracking. So if you are really determined, you feel like you should have something in place, fine, but limit it to those metrics that your various internal subject matter experts agree are very meaningful. But keep it simple, keep it focused. A given risk area with several really good actionable metrics is way better than 50 that no one pays attention to. Then, using the principles that we'll cover throughout this series to critically evaluate additional metrics before adding them to your reporting. Now, as we start to think about the best metrics for our organization, let's just do a quick recap of the 9 types that we talked about in the first video. The first is the type of metric. The first being key performance indicators, basically used to measure essentially production or the achievement of our strategic objectives. The second is key risk indicators, which are used to monitor the risks inherent to our business based on that strategy. And finally, key control indicators used to monitor the mechanisms we've put in place to treat those inherent risks. Now again, the value in distinguishing between KRIs and KCIs is that it can give us a better picture as to whether a risk itself is changing or simply our response to it, which can have two very different responses. Now, on the other dimension, we have the scope of these metrics, starting with the business unit, which are generally only tracked and managed locally by the business, unless they may cut across some predetermined threshold that merits some escalation. Business unit, but aggregated metrics, values that are homogeneous enough that they can be aggregated to see if there's a more systemic pattern. And finally, macro level, which reflects activities from a broad part of the organization, if not the entire, and hence can represent potentially significant risks, but yet may not have a specific owner. Again, from the last video, I'm showing here some of the examples that we put for each of these buckets. If you want, feel free to pause here if you like, but we'll be getting into more examples as we go. The key here is when evaluating our portfolio of various metrics we intend to use, the most critical factor will be whether a given metric has at least some predictability for future events, or in other words, forward-looking. But we also want to give some thought to whether we are heavily concentrated in certain types and possibly lacking in others. Because as you'll see, each of these different types has a specific purpose and value to our risk management efforts. So, now that we've considered the different types of metrics that we'd like to have in place, what's the best way to source the right ones for your company? Now, every company is going to be in a different place on this. Some will have a long list of metrics that they report on. Some may only use a few here and there, and some may not have anything but plan to put something together, and that's fine. For those organizations that have an existing report or scorecard of metrics, at minimum, go back and look at those through the lenses of the characteristics I discussed in the first video, and we'll continue on, and then ask yourself whether you have a balanced list, or if there are areas that are under or overrepresented. We also want to give some thought to, are those metrics actually telling us anything? Are they helping us make better decisions? Or are they simply just memorializing what we already know? Now, even if they are, that isn't necessarily a bad thing, because even the very reporting of metrics still supports a certain level of ongoing transparency. But as we go along and dive deeper into how we look at each of these metrics, we're going to talk about how to evaluate them to determine if they even make sense to remain on the report. Now, for those organizations that either haven't built a reporting dashboard yet or have one but just don't feel confident that they have the right metrics, the rest of this discussion should help us create a report that is truly supporting our risk management efforts. Now, the first and possibly most important source for identifying risk metrics really comes from our risk appetite framework. And again, this assumes that you've developed something, but if not, you can go back to our risk appetite video and look at that. It is here where we establish the guardrails in which we intend to operate, along with the overall strategy being the other guardrail. Now, I touched on this briefly at the end of the video on risk appetite, where I talked about we'll get back to metrics, so we're sort of picking up that conversation here now. For every major type of risk, we captured a series of factors that help establish an objective foundation to our risk philosophy. And many of those are objectively quantifiable. For instance, within the broad category of strategic risk, for capital, obviously this means our intentions around capital levels, balancing between retaining or deploying any excess capital. For growth, that obviously centers on growth rate and the growth rate at which management feels comfortable. For earnings, this means retained earnings, profitability at different levels, etc. For the financial risks, such as say liquidity, we will obviously want to establish a profile around not just liquidity levels, but related factors such as portfolio sensitivity, funding demands, etc. And with the operational risks, we establish parameters for things like numbers of third parties used, numbers of systems allowed outside of planned obsolescence periods, etc. The point here is that because these factors are objectively quantifiable, they are measurable and can be monitored. In fact, they have to be monitored if we intend to operate within the boundaries of our defined risk appetite levels. This is why really the best place to start when considering key metrics is with our risk appetite framework, and why a structure for establishing objective support for our risk appetite is so critical. Remember, the central purpose of our whole risk management program is to ensure that we operate within the parameters of risk appetite. Now, the good news here is that these types of metrics are usually pretty darn obvious and likely already considered in policies and in current reporting. But by going through the risk appetite framework, this just gives us a chance to ask, are we missing anything? Are there key factors that frame our risk appetite that we're not watching? And for those metrics that we are tracking, again, are they meaningful? Do they really tell us anything about potential key risks? Or are we including them just because we can or we feel like we should? Every metric that we include in a dashboard or scorecard must be able to tie back to at least one major type of risk as reflected in our risk appetite framework. Now, we'll come back to this shortly when we talk about documenting metrics. And going back to our discussion about different types of metrics, specifically metric scopes, we had business unit and aggregated, and company-wide. The practicality here is that the metrics we derive from our risk appetite framework are going to be mostly the macro level, company-wide, and potentially some of the homogeneous metrics that originate within a business but can be aggregated together. Again, things like policy violations. This is because risk appetite is generally defined broadly as the general operating parameters for the whole company. The way that risk appetite is translated down into the individual business units isn't necessarily through the subjective statements, but rather through the various limits and thresholds that we establish, and we'll come back to that. But again, these are the types of metrics we want in our reporting dashboards, so this is our best place to start. Next, we'll look to our risk assessments, which is where there are other types of metrics will emerge. Now, risk metrics should also be a byproduct of our risk assessments, since they are, by definition, monitoring assumptions about our key risks, and in theory, the state of them. This will look slightly different depending on whether we're talking about the macro portion or the operational portion, so we're going to look at both. Now, once you've completed the enterprise risk assessment and identified key areas of risk based on either the related assumptions for the macro types or processes for the operational types, the next question you should be asking is, what should we be monitoring in relation to those risks? Again, going back to a much earlier points about what metrics are, the two main questions we are always asking are, how will we know if the risk level is becoming elevated, and in what ways do we want transparency around changing circumstances? Clearly, the more significant the risk, the more meaningful it becomes in terms of monitoring. For true life-ending risks, there darn well better be some mechanisms in place to provide early warning signs if either we are heading in the wrong direction or something truly threatening is coming our way. Once again, risk always lies in the assumptions, and two of the most dangerous assumptions that exist are, one, oh, I'm sure Bob's on top of that. Or two, we would just know if something was changing. No, bad. That isn't in any way what risk management is. Those may be true, but are we going to bet the company on it? Now, as with considering risk appetite, some of the metrics that relate to our risk assessments are going to be stupid obvious, okay? ones we use every day and that we already know are going to be highly correlated to risk. So for liquidity, it's cash level, liquid assets in relation to our funding and contingency funding levels. I don't need analytics to tell me that's important. For lending, it's delinquency rates. For manufacturing, it's production and quality factors, etc. These and some others are obvious because we've learned over time that they have an almost perfect correlation to risk scenarios. Then the exercise is to work to consider additional supplemental metrics that may also be highly correlated, but may not be so obvious until we really think about what a related change could mean. Conversely, there may be certain metrics that sound like they should be front and center until we realize that, honestly, while interesting, they really don't tell us anything. The idea of either dropping or at least de-emphasizing some metrics will rub some people the wrong way. No, they have to be on the report, if for no other reason than, well, they always have been. But what I'm interested in is a tool that helps me run my business and make better decisions, not supporting the illusion of it. So let's think a little bit about the two main types of risk, our macro and our operational, that we covered at length in the Enterprise Risk Assessment series. So starting with the more macro level risks, again, those associated with things like strategy, governance, and external influences. Because these are primarily associated with design decisions the company has made, they are always supported by a set of major assumptions. Again, these assumptions give us insight into the potential sources of risk and often dictate areas that should be monitored for change. The good news, and I touched on this briefly in the risk assessment series, is that assumptions are very often very quantifiable and hence easily measured. But what monitoring looks like will look different depending on the specific risks we're talking about. So let's consider some examples. Going back to our assumption aggregation sheets from the risk assessment videos, we talked about capital planning, which protects the company from one of its most consequential risks. This is a financial risk area and relates directly to a quantifiable, measurable element, capital. So we already have a pretty good idea of what needs to be monitored, capital. When we think about the underlying assumptions, these are largely focused on how we manage capital. So these would really be considered more of part of just ongoing risk assessments or program evaluations and evaluating whether or not we're doing the things we said we would do. This is also an area that tends to have a lot of visibility. In this case, we would probably look more to the supporting materials such as capital forecasts, stress tests, financial reporting, even aspects of strategy, etc., as other areas that may point to key metrics we should consider. Any factor that should be monitored for which an unexpected change could represent a threat to this area. But when we look at a much broader type of risks, say those related to our strategy, then we really do need to consider what should be measured. Again, this would be different for every company depending on the criticality of achieving the strategic objectives. But for strategy, appropriate metrics, which in most cases are going to be key performance indicators, would relate to achieving certain strategic goals, new business volumes, net new customers, etc., as defined in the plan. But if we look at some of these key assumptions that we identified in relation to the strategy, we find other elements that we could also monitor, including new customers, new products, new locations, new regions. Will they be profitable? As a side note, underestimating the true profitability of your products, locations, business units, etc., is one of the most important data points you can know. And yet, it stuns me that many companies don't take the time to figure this out. It's too complicated or we don't have the data. That is really something that should be a priority, and it really is a source of risk management. We could also consider new products offered, new market segments, marketing campaigns, etc. Will they attract sufficient net new profitable customers, etc.? Again, measurable and potentially early warning indicators that critical goals are not being achieved. Even some of the more subjective assumptions can be tracked just in a more manual process. And when we think about some of the key external influences, again, almost every one of these can be supported by meaningful metrics that can provide early warnings. This includes factors related to the economy, regulatory requirements, competition, cyber threats, third-party performance, even certain types of potentially emerging major events. For any of these macro areas and key risks, there are a myriad of things that could be monitored. The question we have to ask is, should we? Again, just because something can be measured doesn't mean that it should. There very well could be some data points that could be included in a general narrative, or maybe in a discussion of emerging risks, or again, just in supporting materials. But for any area where a change can represent a significant exposure to the company, we need to identify what factors will be monitored, by who, how often, and what actions will be taken at different thresholds. Once again, for macro level risks, the practicality is that most, if not all, the really meaningful metrics are probably already identified through our risk appetite exercise, but we at least want to still consider this part of the enterprise risk assessment in case there are other factors that should be considered. Now, when we move to the operational side of the enterprise risk assessment, risks based on operational processes, things get a bit trickier. Not necessarily harder, just trickier, because there are a lot of things to consider. Now, the good news is that processes are already representing an activity, so identifying related metrics can be done as long as there are meaningful quantitative elements that can be measured and that correlate to underlying risks. If you force a business unit to measure a bunch of activities that they know are largely meaningless, this will only diminish their perceived value of the risk program. We really need to stay focused on the things that actually matter. Then, within the list of things that are worth monitoring, the question becomes one of scope. This isn't really an area where we're going to find any bank-wide metrics because we're talking about activities, processes, and each one belongs to a specific organizational unit. So, the two types of metric scope we're considering here, either one, metrics that relate to activities ongoing within a business unit, and that's as far as it goes. Or two, activities which happen with a business but can be aggregated together across multiple units or even company-wide. Now, for operations, metrics are going to be derived generally from one of a couple of areas. Number one, the activity itself. This obviously will largely represent some sort of performance indicator. Two, related assumptions. These could be either tied to the inherent risk, related to mitigants, or even residual risk. And three, risk mitigants, and the tracking to ensure that they are in fact being performed. So let's just consider some metrics that are fairly common to operations. In terms of the process itself, monitoring could include production volumes, average completion times, profitability measures. Collectively, how are we doing in achieving our goals? Next, metrics tied to key assumptions for risk perspectives that are based on assumptions such as no process changes will be introduced. That assumption being challenged could mean something. Anticipated system upgrades are successfully implemented. Staff replacements will be completed on a timely basis. Again, these may support a specific risk perspective, but if that focus of the assumption changes, we may need to revisit that view. And finally, metrics tied to our mitigants, and these would generally be KCIs, could include things like, again, policy violations. In my mind, one of the best metrics that we have. Quality factors, staff turnover, etc. Now, this isn't to say that every one of these has to have a metric in place, but anywhere where they really relate to key risks. Now, beyond this, we can also look to any of our other risk assessments, maybe topical or other horizontal ones, and ask the same questions. What should we monitor? Along with what can we monitor? These could come from a compliance risk assessment or a cybersecurity or a fraud assessment or a financial analysis. Any of our tools that help us understand our risks is a potential source for a monitoring tool. Remember, metrics help us monitor moving parts because risk assessments are only meaningful as of a specific point in time. Now, as we go through different areas and we continue this process of identifying potential metrics, there are just a couple of additional things we want to consider with regard to whether or how we use those metrics. Now, at minimum, for a metric to be included in the dashboard, it has to be determined to be highly correlated to a risk. And if not, it shouldn't be there. It'll only distract. Now, we're going to come back to this in the next section when we get into documenting. We'll talk about this in detail. But we also want to think about whether a given metric is active or passive. In other words, is it used to derive immediate decision making or just simply informative maybe of a pattern? A metric that's reported quarterly isn't particularly meaningful to decision making. So the reporting cadence may be different depending on specific events. So once we've come up with our list of metrics that has a meaningful correlation to risk, the next question to ask is, how often does it change? And if it does change, how quickly does something need to be done about it? And then we can decide about, again, what's going to be our reporting mechanisms for this immediately through a management team or through a risk committee or whatever. And then next, a quick note on the slightly, if not highly controversial subject of objective versus subjective when it comes to metrics. Now, this can be a highly debated topic, and people often land dogmatically on one side or another of this one. You know, the old saying, what gets managed gets measured, and it's most commonly attributed to the brilliant management theorist Peter Drucker. The funny thing is, and even by the Drucker Institute, is he never actually said that. Instead, V.F. Ridgway, in a paper published in 1956, I think got it closer when he said, what gets measured gets managed, even when it's pointless to measure and manage it, and even if it harms the purpose of the organization to do so. So, adding to our earlier points about how just because we can measure it doesn't necessarily mean it's meaningful, which should give us some foundation to simply ignore certain metrics that they really don't tell us anything. I really do believe that we should be open to considering a certain number of metrics that, while not perfectly quantifiable, they still tell a story and can lead to transparency and accountability around key areas of risk. Okay, before we move on, we covered a lot today, so I just want to summarize a couple of points. First, if your program is early stage, starting with a dashboard just to produce something is not the best way to go. Metrics represent risks, so understand those first. And besides, the obvious metrics are probably already being reported somewhere anyway. It's much better to take your time, understand your risks, and then develop strong metrics around that understanding. Second, try to keep the 9 types of metrics in mind. Each has a purpose, but some are often overlooked. And it's a good way to consider, are we using metrics in all of the right ways possible that can benefit our program? Third, most of your macro metrics will really come from the risk appetite framework and macro portion of the enterprise risk assessment. Those metrics that really relate to the overall company. Some are obvious, but some may not be, so it's still worth going through those frameworks to see if there's anything else that should be monitored. Fourth, the risks related to processes, operational, contain thousands of moving parts. Take the time to really think about which parts truly correlate to potential risks. Again, just monitoring a bunch of moving stuff just because you think you can or should is really going to frustrate people. They really need to understand that the things that they're monitoring really have a purpose and are meaningful. And finally, after completing any risk assessment, I don't care what the scope or focus is, the last question you should ask is there something else that we should be monitoring in relation to these risks? So, this now brings us to where we believe we've developed a decent inventory of meaningful metrics that will help tell a balanced story about our business and will yield meaningful management tools. So this is a good place to take a break. In the next video, which I promise will be coming very shortly, we're going to go into a lot of detail about what I think is one of the most important parts of the process, and that's documenting our metrics. And then finally, the part you've all been waiting for is presenting these metrics in our scorecard. Because in the end, what's the point if we don't end up with pretty pictures? But trust me, I think you're going to like how we look at presenting this information and using it as foundational to make meaningful, actionable decisions. So, as always, please do me a favor and like this video. If you hadn't, hit that subscribe button. They really, really do help out the channel to get it promoted out there, and thank you for watching.